afternoon, everyone, and welcome to the debut edition of 7investing Now. We're testing a new platform. We have new technology. We don't have green screens. We don't have Steve Symington. We planned on having Steve Symington. We are putting things together on the fly. We kind of told some of you this is mostly a demo show, so bear with us. This is going to be a different type of financial news program. At 7investing, our mission is to empower you to invest in your future. That means we won't be reacting to the news of the day or worrying much about short-term market moves. Instead, we're focused on helping you play the long game so you can figure out your investing style and risk tolerance so you can control your financial future. My name is Daniel Brooks Kline. You can call me Dan. I'm being joined today by our CEO, my fellow lead advisor here at 7investing, Simon Erickson. Simon, how are you?
Dan, I'm fantastic. This is a lot of fun. And like you said, what better than a live test? How can you get more real than going live like this is? So I'm excited to see how this goes.
I don't think we can. I don't know who's out there. Simon, before we get started, why don't you tell people a little bit about yourself and sort of why you founded 7investing?
Sure. I'm a believer, Dan, that individuals can outperform the broader stock market. I believe that no matter what's going on out there, if you're looking in the right places and finding the right companies, you can massively outperform the S&P 500. And we've shown that it can be done. And that's kind of how we started 7investing in the first place, was to go out there, find those opportunities, make them actionable for individual investors, and then do the handoff and say, hey, now it's in your hands to figure out which of these recommendations that we're putting out there is right for you. And so we're not managing anybody's money directly. We're giving actionable ideas every single month for $17 a month.
Yeah, and what's really cool about it and why I was exceptionally excited to join is we're all really different. So I'm a pretty conservative investor. I own a lot of companies that you look at and you go, okay, that's going to do well, but it's not going to set the world on fire. It's not going to be a 10,000% gain. That tends to be more my style. But then occasionally I'll throw in a pick out of nowhere that's just like, you've never heard of this company. It's something I'm really into. And then you've got, say Max Chatsko. He's picking these biotech companies I've never heard of. So we'll tell you a little bit later about how to join 7investing. But first, let's get into the show. We're going to cover, this is 7investing Now. We're going to cover the news of the day, but with a long-term perspective. This is a work in progress. As you could tell, not everything is done. Our platform isn't done, but this show is going to be archived on YouTube. You're going to be able to find it basically on every social platform. Right now, that means YouTube, Facebook. We're going to be on Twitch. Eventually, we're going to be on MySpace. We'll be on classmates.com. Now, I'm kidding. We'll be wherever you can find shows, and we appreciate you helping us get the word out. This is a team effort. We don't have hundreds of millions of dollars in the bank. We are doing this grassroots style. With that, seven investors, that's what we call you, 7investors. You join our family, we make you part of the family.
I like that, Dan.
You created it. I had other suggestions. I was saying Army was my suggestion. We might use that occasionally as an alternate, but I like 7investors. It's a little tricky to get used to saying. We're going to open up with the top story. That's the biggest story of the day in the financial world. That's going to be followed by a segment called What We're Watching. That's when we each bring a story to the table and we're going to talk about. Then we're going to finish up the show with questions about long-term investing you asked us on Twitter. Now, Simon, we planned to have Steve Symington here. So questions I was going to throw at him, we're going to throw at you. Of course, we're going to skip his segment. We're not going to do the story he put out there. We're going to talk about that one on Friday. So here's the top story for the day, and it's in two parts. So kind of call it top stories. The Dow took a sudden drop after President Trump called off stimulus negotiations until, quote, after the election. Of course, he walked that back a little bit overnight after he saw the market. Simon, should we worry about this? Is this going to send the market tanking? Clearly, it hasn't. It's done better today. Let's give some perspective on this. What does this mean?
Well, okay, so let's look at the numbers first. We're at GDP growth of about 3.4%, still at about 8% unemployment, which isn't terribly bad, right, Dan? It's a lot better than we were 6 months ago, but it's still a lot to be desired from where we are right there. And so much of that is inflated, of course, by stimulus, by the PPP loans for small businesses, by the checks that are coming to people, $1,200 checks to go out and spend money in the economy. So, of course, more stimulus would be good for the economy and good for the stock market. But again, stimulus is meant to be a crutch while our economy is healing, not something that we're permanently expecting. So innovation is going to happen no matter whether there's stimulus or there's not. There's pockets of the market that are going to do well without this. I think that if you're looking at 3 months out, yeah, stimulus is going to be important. If you're looking at 3 years out, I think that this is something we're probably not going to be talking about in 2023.
So one of the things being held up here is there was essentially the promise of $1,200 checks to every individual, $2,400 for a family. Last time you got $500 per kid. That being said, if that doesn't happen, is that going to hit the market, or is that really just going to affect like local business and sort of the sort of hidden part of the economy that's really, really struggling that's not reflected by the market?
It's going to be the S&P 500 as a whole. Businesses are definitely going to need the stimulus because so much of it is driven by consumer spending. Consumer spending is what, 70% of GDP or something like that. And so when you look at that 3.4%, the GDP growth, so much of that is tied to consumer spending. Extra $1,200 in your pocket goes a long way for the economy as a whole. Steve said the same thing. We saw Steve's notes, and I will do my best Steve Montana impression here by trying to relay what he had to say. But he said the same thing, that he's not really worried. He says, take a deep breath and ask yourself whether these tweets are really going to make or break the economy. I don't think so. I don't think even the stimulus itself is something that it's been a nice to have and necessary for the short term. We're obviously dealing with a lot of stress from COVID right now that's stressing out the economy. But at the end of the day, the economy is going to recover from this. And this is something we're not talking about, I think, in a couple of years.
Yeah, what's amazed me is how the tiniest bit of news can dramatically move the market. So markets were doing great yesterday, flying high. And then the president comes out and says, well, we're not going to negotiate on stimulus anymore. And that's politics. That's not, and then, of course, when the market tanks, he then at night says, well, like right now, we'll give everybody the $1,200 check if you agree to it. A lot of this is political theater. And I don't react to the daily market moves because, like, I looked yesterday and everything I owned was in the red. I look today and not only is everything I own in the green, it's actually like in the green since when I've owned it. And I've bought shares of things like this week that were down, quite a bit after yesterday. So it's really volatile. It's not something I think about on a day-to-day basis. And 7investors, this is what I can tell you. Don't worry about short-term market volatility. And we're going to see a lot of it. Somebody's going to come out and say a COVID-19 vaccine failed, or a COVID-19 vaccine succeeded, or now COVID-19 flies on the back of murder hornets. You don't know what the news is going to be. It is going to move the market, and you have to divorce yourself from that. You have to step back and say, okay, why did I buy this company? Was that changed by this news? Now, if you bought a lot of shares of, say, cruise lines based on optimism earlier in the week, and there's some negative COVID-19 news, well, that might hurt your thesis. But for the most part, that generally isn't what happened. We're going to stay in the political realm, Simon. So the House Democrats just released a report on why Amazon, Apple, Facebook, and Google hold monopoly power, and in some cases should have parts of their business broken off. There's actually bipartisan support for this for totally different reasons. Like, there's the conservative idea that there's a bias against them, so they want to punish these companies. And on the Democratic side, it's the idea that they're monopolies. If you're an investor in any of these companies, and I don't know if you are, Simon, you're welcome to say if you are, does this worry you at all?
I certainly am an investor in big tech companies, Dan, so I'll start with that one. And to answer the second question, just right up front, no, I'm not worried about this. The largest antitrust fine that we've ever seen, the regulation that brought the hammer down, so to speak, was from the EU on Google back in 2018. $5 billion fine, Dan. That sounds like a ton of money, right? They got hit with a $5 billion fine. And then you see Google that year, Alphabet, during the year produced $50 billion of operating cash flow. So 1/10 of the cash flow that they produced from their business during that year went to this fine. Regulations have continually been the mosquito that's annoying the big tech companies and kind of buzzing around, but it's not biting in a way that's been crippling or even harmful for a lot of their businesses. Another example we saw was Department of Justice just recently issuing a statement that it was not going to regulate the terms and conditions for Facebook or other social media sites. It was up to them to self-police themselves and take down harmful content. And that was another big statement that they're basically saying, look, there's stuff going on. You've got to take control of this, but we're putting the ball in your court to take care of these things. And so regulations to me, Dan, I mean, this is kind of the long tail risk we've always worried about. We've always worried about big tech companies getting broken up or being overly regulated, or interaction and intervention, I should say, from the regulators that be. But really, just going on 20 years of these companies existing now, it has not packed the punch that so many investors worry about. It's not saying it's not a long tail risk. I just haven't seen anything that's really affected these businesses yet.
Yeah, I worry a little bit about sort of government arbitrarily forcing these companies to split up. Like, is Facebook going to have to sell Instagram? Well, Facebook and Instagram are really integrated. They work well together. What, do they have to get rid of Messenger? Is Google going to have to make search a separate company? I don't think Congress, and I mean this nicely, is up to regulating these companies. I think we actually need some variation on OSHA, and I've talked about this a lot in various formats. My family owns a ladder and scaffolding business, and ladders are an OSHA business. And basically the industry comes together and writes a standard. And obviously they're competitors, so they're trying to make something that's as fair as possible for everybody. And yeah, it might hurt the little guy, but all the big guys are going to have to give. I actually think that makes a lot more sense than sort of randomly having the government, which has shown it doesn't understand how any of these products work, randomly having them regulate. That said, I'd like to see a lot more responsibility. There's an awful lot of irresponsible content on all of these platforms. There's a lot of Google results that you look at them and go, that benefits Google. It doesn't necessarily benefit anybody else. So Simon, before we transition off of big stories, let me throw out one question I get asked all the time. Does the election factor in to how you invest in any way?
Yes, I think it does. I think that, we don't spend a ton of time maybe obsessing or thinking about this, but I think that there are things you probably shouldn't ignore in terms of politics and how government influences the markets and companies and where the opportunities come from. One example is, we look at Biden's healthcare plan, right? That's going to cost $2.25 trillion, an estimated $2 trillion. And so, of course, that's going to be taxes that have to go to that. That's going to be a big win for certain segments of the healthcare industry. But, that is an impact to the economy that is politically fueled. We know that Trump has lowered the tax rates for corporations to 21%. That is an impact to the income statement of those companies and the earnings that they report out there. And so there's definitely an interaction between kind of this political sphere and then this market sphere, this free market sphere. I don't think we need to say that good companies are no longer good companies just because of what's going on in politics. But I do agree that there is a correlation between them, Dan. We should pay attention to it as investors.
I got to be honest, it's not something I worry about that much, because as much as the Trump campaign, and we don't take political sides here. That's that's something at 7investing we are for everybody. But I will say, and it's generally super PACs. It's not even the campaign, but they're basically running commercials like implying that Joe Biden is some sort of crazy socialist. Joe Biden is a moderate. Like, there's no other way to look at it. He's arguably a pro-business moderate who might want some legislation to encourage things to be made in America. But the idea that he's all of a sudden going to socialize Apple or it's just not going to happen. So as much as these guys are different, and obviously they're two very different people, I think if Biden decides to roll back tax cuts for people who make over $400,000 a year, that's not going to have a massive impact on the market. So I'm really not that concerned about it. Where I am a tiny bit concerned is the fact that we could have a contested election. I don't think that's likely, but I think if we have like a 2-week period where we're counting ballots, something that here in Florida we're really bad at. I don't know why we don't have like a machine or like a team that's good at that, but we don't, and it's always a problem. So that, I think, could create real, very short-term uncertainty.
Yeah, I agree, Dan. I mean, Chris Mayer just did an interview with Steve for our Steve Simonton for our 7investing podcast, and he wrote a book about how to find 100 baggers, which is companies that have gone up 100 times from your original investment, which is incredible. There's only a handful of those that are out there right now. But the things that they have in common was they were just able to kind of reinvest in the business and get greater and greater returns out of that were then shared in shareholder-friendly ways. And so you think about the long-term nature of something like that. You think about the compounding nature of companies that do a fantastic job at that. I mean, the political side of this is They specify what's out of bounds and they specify where the end zone is, but then let these teams run on their own. And good companies are going to find ways to win no matter what the rules are. We want to think when we're long-term investors about those kinds of companies. Do they have the opportunities to keep growing and compounding? That's how you're really going to make wealth in the stock market.
So 7investors, I see a lot of you in the chat sharing comments. I haven't quite figured out how to watch the comments kind of while I'm doing something. This is new technology for all of us. We'll get to some at the end, but I really appreciate everybody who, maybe followed us over from the other place. So, that is really appreciated. We're going to get to what we're watching. That's stories that we're really excited about today. But first, this program, of course, 7investing Now. We haven't even officially announced the name or made a graphic. That's how new this program is. It's eventually going to look like television. We've got amazing things planned for it. It's brought to you by the team at 7investing.com. At 7investing, we offer a simple proposition. You give us $17 a month or $170 a year, and our team of advisors, and these are some top-notch folks, gives you our 7 best stock recommendations each month. Of course, that's not all you get. You also get access to us. So we're working on what that's going to look like, but think live member Zooms where it might be you and 30 people asking me and Simon questions, or Max and Austin, or Steve and Matt. It could be any combination of us. Eventually, there's going to be a blog on the site where, sure, there's going to be some public-facing stuff. There's also going to be added insights from us, maybe baskets from our picks of, hey, these are the ones we picked. Are you this type of investor? These might be 5 good stocks for you to buy. We're going to help you figure out. We know 7 picks is a lot. We're going to help you figure out what the right thing is to do. And we hope you join us. Go to 7investing.com/subscribe. Subscribe. We want you part of the family. Simon, anything to add there?
I do. Dan, the first thing I'd like to say is I think that we owe ourselves some money for that ad read. That is not a third-party advertisement. We don't have any advertising on our site, right? Our only way of making money is through subscription. So we're thankful for everyone who subscribes to 7investing. Thank you for support. We're not putting advertisements out there. We're not monetizing in any other way other than subscriptions. And we only have one product. We're not upselling more expensive products. It's basically just one product where you get access to the team's best ideas every month. And it's $17 a month or $170 a year, Dan. So by my math, you're getting 2 free months if you sign up for the year instead of just the monthly rate.
Yeah, and I think many of you know, I'll give out my email. Kline, DKLINE at 7investing.com. You could use the number or you can write it out. It works both ways. I answered all your emails. You message me on LinkedIn, I answer. Now, I can't give personal investing advice. None of us can. We don't know your situation, but we are happy to talk. We are happy to help. But let's get to what Simon is watching. Simon, you are excited about the Palantir IPO. Why don't you tell people a little bit about what this company is, what it looks like?
This is a fascinating company. It's also a very controversial company, which is why I think I like it so much, Dan. It's one of those that's going to be in the news a lot. It actually was not an IPO. It was a direct listing, which means the company didn't put any more money on its balance sheet by going public. It cashed out insiders and they sold their shares to the public markets. It's the same thing that Slack did. We've seen this from a couple other tech companies out there. But what Palantir does is it's a data aggregating company. And so what it does is it takes a ton of information and it makes sense of the signal within the noise. And so its largest customer so far has been the US government. It's been around for 17 years, working largely in counterterrorism, for soldiers, for finding that needle in the haystack that's very, very important because it has to be perfect because safety is at stake. There are a lot of important things at stake. And it's gotten really, really good at this. And again, Dan, it's been around for 17 years, largely as a contractor for the US government.
So, Simon, if I remember correctly, this is a money-losing company. It's also incredibly dependent on the government. How much do you worry about that?
It's about half and half in terms of the sales split. And the reason that I think it's so interesting right now, Dan, is Palantir has said, we're going to open this up to businesses now. They've got 125 businesses that they've disclosed. A lot of those, you can't talk about it because of the secretive nature out there. But they realize, a company that's like this, that can find insight that's really important for businesses to learn from is incredibly valuable, right? Airbus has got Palantir's technology tracking 9,000 airplanes all across the world. And all of these signals that, the data that's coming from those to make sure that safety is going to be 100% accurate and it's got to be perfect. And you start thinking about this kind of industry, and this is something where the winner will take most. You don't want to have 43 different data aggregators. You want to have one that's really, really good that you can count on. And so Palantir has got an average contract of $5.6 million a year per customer. Here we are, a lot of software platforms, we're talking about $100,000 a year, right? Maybe if it's a really big platform, it's $1 million account that you've got. The average for Palantir is $5.6 million across all of its customers. And that even subdivides the government contracts into smaller groups too. And so this is a huge platform, huge contracts, huge customers that's now looking to scale into the mass market, Dan. It's fascinating to me that they're doing this right now.
So Simon, last question here, and you can talk generally about IPOs. I know that I personally, no matter how much I like a company, unless I intimately know it, like it's a product I used before it went public, I'm not touching it until they've reported quarterly earnings at least a couple of times. Is Palantir one you'd make an exception for? Is it one you're really excited about? Or in general, sort of, how do you approach IPOs?
I'm digging more into the valuation on this one, Dan, because, like we said, this was a direct listing. So the people that benefited from it going public were the insiders, not the company itself necessarily. The second thing is they're paying out a third of current revenue as stock-based compensation. So that's very generous for a tech company. But then on the other side of it, we saw the contribution margin from this company, which is when you take out sales and marketing expense, you back out the stock-based comp that they're paying. Increased from 17% in the first half of last year to 56% in the first half of this year. The scalability is amazing because they built out a platform that works really, really well. And that's what's so interesting. And so to answer your question about IPOs, it has to be a case-by-case study. Valuations are very expensive, at least compared to traditional IPO metrics. But on the other hand, you've got a new definition of success in software, which is you've got recurring revenue and you've got scalability. And so all of a sudden you're looking at something that grows like a hockey stick rather than just a linear growth. That changes the game when you're thinking about 3 or 5 years out too.
I'm very wary of IPOs right now because, we've seen some companies that people knew nothing about just shoot up, and sort of a fundamental misunderstanding of how IPOs work. Regular folks, and I'm going to assume most of the people watching this are, like you and I, regular folks. We don't generally have access to IPOs at the listing price. And even if you put in, hey, it's IPOing at 20, I'm willing to pay 25, it might blow by 50 before you get even a hint of a chance at doing it. So look, if it's a great company, go back on like an Amazon or a Microsoft on a 10-year chart from their IPO. It didn't matter if you got in the first day or the third quarter. It's not that important. Like in some cases, it'll be 5,000% growth versus 4,800%. It doesn't matter. So you really, in my opinion, you want to see the CEO do an earnings call. You want to see someone address what's wrong with the company and how they're going to fix it, and whether they actually address that again in the coming quarter. But as is usually the case when I'm hosting a program, Simon, we're going to go from the serious to the silly, but I do think there's an important investing lesson here. My story that I'm watching here is McDonald's has added bakery items to its menu in a push for breakfast companies. They're adding an apple fritter, a cinnamon roll, and a blueberry muffin. Now, the reason I brought this up is I kind of feel like McDonald's has absolutely botched breakfast. So we don't eat breakfast at breakfast time anymore. What did McDonald's do? They got rid of all-day breakfast. That makes very little sense when if someone isn't going to work and they want an Egg McMuffin at 2 o'clock, no, they can't get it. I also think these items make a lot of sense, but why didn't they do this 3 years ago? Or when Wendy's launched breakfast, where was the McDonald's answer? So I like McDonald's breakfast. I don't eat a lot of fast food breakfast. But that being said, Wendy's launched with a superior product, and McDonald's did nothing to counter. And that's a troubling thing for me of their overall strategy. Now, I'll give McDonald's the benefit of the doubt. They're an execution play like Domino's more than they are a food play, whereas Wendy's is trying to be a food play. But I don't think they have their priorities in line, Simon.
Now, Dan, first of all, now I'm getting hungry with you talking about all this food. Some of our listeners, Todd Campbell just said he's gaining weight listening to that breakfast menu. So I do love this. It's a kind of a fun story, kind of a serious story too, though. But McDonald's has a lot of franchisees, right? So if you're offering breakfast throughout the entire day, does that have an impact on the service or the speed of service within the restaurants?
So here's the problem. The reason they backed away from all-day breakfast is their franchisees complained about it. and because you have to make different things on the same grill. Now, my opinion, if you're McDonald's, figure out how to make it easy, whether that means you buy another grill, you hire another person, you automate something. I don't care what the answer is, but the customer should be dictating what you do, not the franchisee. And I understand McDonald's is a franchise-driven model, so it also has to please the franchisee, but they could find a way to please the franchisee. Hey, we're going to send you a new $50,000 grill and bill you for it in 1% increments for the next 10 years or whatever it is, and you'll be able to do breakfast and lunch at the same time, and it won't be a conflict. But right now, more than ever, you have to focus on what's going to make people happy, what's going to give them comfort. And Simon, getting to eat a McGriddle at 2 p.m. might bring people some comfort. And I just feel like this is actually something that makes me question management. When they're putting getting stuff out quickly over giving people what they want, I think you can do both, and they're not doing it. We, of course, had a segment planned with Steve Symington, who's watching in the background, but we had to scrap that. He had internet trouble. So next, we're going to do what I call the social segment. We took to Twitter for this one. I asked my Twitter followers, what question about long-term buy and hold investing would you like to see us answer on 7investing Now? They came back with some great ones, and we're going to tackle them. Simon, this is from Ship of Fools GD. The GD stands for Grateful Dead. He's a Grateful Dead fan.
Fantastic.
One of the times you sell is when your thesis is broken. When do you consider a thesis to be broken?
I mean, the thesis is broken when the company is no longer executing on what it said it's going to execute on. And so if management comes out and says, we're really excited about this new market, we're going to put a ton of money on it, and this is our future, and then it flops and they actually lose margins and the revenue goes negative, that's a thesis buster. You have no faith in the management team because they didn't do what they said they were going to do. And so for me, the thesis buster, you can give a company a lot of credit if it misses quarterly earnings, if it has a little bit of a slump in sales, and they've got good reasons for that. But if the company is not executing against its own plan and missing its own internal guidance significantly, that's a thesis buster for me.
Yeah, for me, it's also if a company makes a major pivot in their strategy. Like, if the one I always talk about is Starbucks. I was a big believer in the premium strategy for Starbucks. I love the Starbucks roastery. I thought the premium stores were going to do really well. And when there was a CEO change there, the new CEO, Kevin Johnson, said, let's pump the brakes on that. Let's focus on execution. And that made me step back and go, wait a minute. And then I saw him go take shifts in stores and actually figure out, okay, we can automate this. We can make service faster here. We can deliver better. We can serve the drive-through better. And that paid off incredibly well in the pandemic. So that was a thesis changer. But I stepped back, I watched it happen, and I went, okay, he's going to come back to what I care most about. But what he cares about is also important.
Dan, I might chime in too for Steve, and I'll do my best Steve impression. I've got to put on about 40 pounds of muscle to pretend to be Steve here, but I'll do the best I can. He says that he actually likes seeing companies pull back when they change the way that they're making revenue. And so he brings up the example of enterprise software. Sometimes companies are capturing a lot more money up front in a perpetual license model, but then revenue grows more slowly for reasons, the only reason being that it's shifted to more of a ratable month-by-month kind of calculation. And so a lot of times, you see revenue growth slowing, but something like that is at much higher margins, producing better cash flows for the business. He likes when something like that happens because he thinks it's actually an opportunity to buy into a stock.
So we're going to take a couple more of these, and we urge you, when we post something on our Twitter, on the @7investing Twitter, on @worstideas7. Simon, what's your Twitter?
I am @7innovator.
When we post something, if you answer it, one, we might name check you on the air, but also it's pretty cool that we're interacting like this, and we'll bring these back up on future shows. But Sarah Lee asks, when should you take profit, still keeping a position, and what's the best way to go about it? Some have mentioned playing with the house's money. What other suggestions are there? So I'm going to jump in first here, Simon. Playing with the house's money is a Jim Cramer term, and Jim Cramer is an idiot. I hate to use such a harsh term. Jim Cramer's playing for television ratings. If you own a good company and you sell it to be playing with house money, you're costing yourself money. If you believe in the company, you're still excited about it. This isn't blackjack. I understand in a game of chance where you have slightly less of a chance of winning if you play correctly. The odds are slightly against you if you're not counting cards. I understand taking winnings out. In the stock market, where if you play it right, you should be able to consistently win, there is no reason to take money off the table. But here's when I do take money off the table. Let's pretend my biggest position is Microsoft. If Microsoft became 40% of my portfolio and I wasn't 100% convinced it's still got huge room to grow, I might trim that down because it wouldn't pass my can I sleep at night test because one company is too much. So I don't really try to time it. I just sort of look, and if I have a massive winner and all of a sudden I realize like, oh my God, this new tech stock I'm 90% sure about is now 50% of my portfolio, that's when I'm going to take some money out. Simon, when would you do it?
No, I agree with everything you said, Dan. I can't add anything else except I'd like to put you on the spot and ask a related question since we're talking about taking money off the table. Casinos versus investing. I know you're a casino connoisseur. Are there parallels between the investing world and the gambling world?
Do your homework. So I play blackjack, and I just mentioned, you can tilt the odds in your favor if you count cards. It's not actually illegal to count cards, and nobody cares if somebody playing $10 blackjack is counting cards as long as you're subtle about it. So I look at blackjack as math. Even if I play video poker, I've read every book there is to read on video poker, and there are different strategies you could use to maximize your returns. It depends what you want. Is your goal to get a big win? Well, then you have to play those percentages. Is your goal to grind out casino loyalty points? Well, you have to play different ways. Simon, I go on a lot of free cruises. I book a lot of free nights in Vegas. And it's because, so both of them are about knowing what you're doing. Like, I don't go play a casino game I don't know how to play unless one of my friends, and a lot of you watching know I travel with Matt Frankel, a former colleague of ours. And if he shows me how to play a game and helps me not make a mistake, I'll learn how to play live. But I'm not going to go sit down and learn how to play, say, 3-card poker and lose a bunch of money. I'm going to read the books. I'm going to do the homework. I'm going to play the live online simulations. And I think the market is very much like that. Now, of course, when you join 7investing, we can help you do all that homework. If you're getting a pick from Simon Erickson, from Dan Kline, from Austin Lieberman, from Steve Symington, Matt Cochran, Max Chatzko, the homework has gone into those picks. That said, we'll still give you the context. We'll still answer those questions. Let's take one more of these, and then we're going to go to the big finish there. The Lone Deranger, that is a great name, says, if a stock doesn't pay a dividend, when do you sell? Wow, that doesn't factor in at all for me. Simon, your thoughts here?
Yeah, I mean, those are kind of two different buckets. I don't think of if it doesn't pay a dividend as a stock that you necessarily shouldn't hold or should consider selling later. I think that yeah, man, tough one, Lone Ranger. If it does not pay a dividend, when should you sell? I say you sell when the thesis is busted or you just have a better opportunity out there. We definitely want to be buy and hold investors. I think we sometimes convince ourselves it's time to sell based on valuation or based on headlines we read or based on things that might be temporary. And we always want to be long-term investors. But also, I mean, I don't think there's anything wrong with also saying, hey, I just see that there's a better opportunity for your money. And I think that that's an opportunity cost question that's very personal for every investor of, hey, if you invested in something and held it for 10 years, do you have to hold it for 10 more years? If the company has changed or there's better opportunities or the markets have changed? No, I mean, this is all compounding wealth, what we're trying to do out there. And so dividend part of that question aside, I think there's various reasons to sell. Just my counsel would be don't try to talk yourself into selling for reasons that might not be the right reasons.
7 investors, we appreciate you watching this. Remember, this is a test episode. It's a demo. We are figuring out the technology. Our friend Todd Campbell says, Dan, spot on. Customer is what matters. Never understood that either. He's talking about McDonald's. Joey Kline says, laugh out loud. Not a relative, but a friend. I have nothing personal against Kramer. His thing is that he's just trying to beat the market on a short-term basis, and that just doesn't help me as a long-term investor. And yeah, also, it doesn't work. Nobody is smarter than the market on a short-term basis. His goal is TV ratings. That's the most important thing. I could say outrageous things and get on CNBC. I'm pretty good at this. It's not hard to go make, the stock market will have an 80% crash in the next 3 months. You know what there isn't there? Accountability. We have accountability at 7investing. We show you all of our picks. And 2 years from now, when I've made a pick and it's down, I might say, yeah, my thesis was here's what's going to happen. And it might happen 3.5 years in. It might happen tomorrow. We're going to explain that to you. We are going to be honest. But we have the final segment here. This is going to close our first ever episode of 7investing Now. And I wanted Simon to comment on a poll I recently shared on Twitter. And I'm going to try sharing it here. I think that works. So I am most worried about, and the choices were the economy, my job, the election, and a family member. It was pretty close, but the election won at 32.6%. That was followed pretty quickly by the economy, 20% by my job, and 18.7% by a family member. Simon, I'm going to let you weigh in a second. I would say for me, it's really family right now because I've been doing great. I hate to say the pandemic has been good for me. I'm not spending as much money. I see my wife a lot more often. I've spent a lot of quality time with my son, and I'm working like crazy. So it's been a good pandemic, but I have a cousin with leukemia who's immunocompromised. I have sets of elderly relatives here in Florida, and I kind of feel like if they go to like Publix at the wrong time, they're going to die. Like, so that's been my overwhelming concern. Simon, what are your thoughts on this poll here?
I vote choice D also, Dan. I think family is number one most important thing. Safety is the most important thing. That, if we can get through this COVID pandemic, the economy and the jobs, those are going to fall into place too. But let's focus on, to me, the most important thing to focus on is family and safety.
Yeah, and I said at the top, I'm not overly concerned about the election. Like, I'm worried about it a little because obviously we're at a really difficult time as Americans. But I do think we're probably going to be okay. And thanks to Simon, I'm not worried about my job. I'm very excited about my job. That, folks, that 7investors, gonna have to get used to saying that, is the first edition of 7investing Now. It'll be archived on our YouTube channel. Go follow us on YouTube. We're going to be promoting the show all over the place, but right now the best place to see the replay is on YouTube. And thank you all. Please join us over at 7investing. We are having a good time. Simon, this was fun. Thank you for doing this.
Dan, I had a great time, and I'm thankful for everybody that supports 7investing. Like you said earlier in the show, we're not just picking stocks out there. We're also following up on those and answering questions and trying to help people kind of figure out this crazy thing that is the stock market. So first of all, thank you to all of the support. Secondly, thank you to my team. We have an incredible team here on 7investing, and we represent so many different segments of the market. You mentioned those earlier, Dan, that, Max is looking at some biotech stuff. Austin's looking at cloud computing. Steve is looking at artificial intelligence. Matt Cochran is looking at digital payments. Dan, I know you're looking at entertainment and media, and I'm looking at a lot of things going on in healthcare. We've got a lot of different segments of the market covered, and we want to make this a buffet of options for our subscribers to choose from. And lastly, Dan, I have to thank you too for putting this live stream together. This is really your baby. You've done a fantastic job with it and hosting the show. I'm looking so forward to more of these in the future.
This was really fun. And let's talk a little bit about, so you see the six of us and the mysterious seventh coming soon that are the lead advisors. What you don't see is the behind the scenes team. Simon, why don't you call out a couple of the people that we didn't make this show happen. We just showed up and hosted. Other people did that work. Why don't you call them out a little bit?
Thank you to Ashley Wilson, our Director of Analytics. Thank you to Samantha Bailey, our Director of Marketing. Thank you to JT Street, who's doing some phenomenal work in marketing. Thank you to Jeff Richards for putting together this live stream and production. Thank you to our IT team. A zillion other thank yous. This is a team group. We're all very excited about what we're doing, and I'm thankful for the team that I work with here at 7investing.
So with that, we will be back Friday at noon. In general, we're going to tape this show Monday, Wednesday, Friday at noon. We're not going to settle into that cadence fully in the month of October. There's some behind the scenes things we're working on, like a really awesome open for the show, some graphic elements, figuring out the platform, maybe getting us on some other platforms. But eventually that's going to be the cadence. But we'll be back Friday at 12. Hopefully Steve Symington will have his technology sorted out. With that, enjoy your day. We'll be back Friday.